Understanding technical analysis can mean the difference between making a lot of money and losing a lot of money. In this video, we're covering Technical Analysis 101 for new beginning option traders. We'll talk about the different price patterns as well as technical indicators so that you can profit in any market and enter and exit trades at the best possible times for max profits.
In this video, we are going to cover how should you use technical analysis. How do you read a candlestick stock chart? What is price support and resistance and how should you use them? What is a trend line and how do you use it to trade stocks and options? What are technical analysis formations and how should you use them to trade stock options? What are pennant, flag, wedge, cup and handle, head and shoulders, double bottom, and double top stock patterns? And finally, what are technical indicators, including RSI and moving averages?
Hey guys, Darren here. We've got a great video for you here today. Before we get started, if you appreciate the research that goes into making videos like this, please do me a favor and hit that like button so we can get the video out to as many people as possible. And if you have not subscribed, please do that as well so you're informed of upcoming future videos. I really appreciate it, so thank you very much. Today we're covering technical analysis for stock option trading. I think it's super important that we understand the ways that the rich are getting richer and we use the same strategies that they're using so that we can profit in any market as well.
Be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. How should you use technical analysis? Guys, technical analysis is not the end-all in stock or option trading. However, it is a tool that can be used along with fundamental analysis as well as earnings reports, conference calls, and news. Now, if we use all of these methods and tools, our chances of making a lot of money are going to drastically improve. And if you are going to enter into a new option position, why not have the charts in our favor right off the bat? How do you read a candlestick chart? Let's look at a candlestick chart for Tesla on Yahoo Finance. The green bodies, or the broad midsection, are up days where the stock price closed higher than the previous day. And the red bodies, the stock price closed lower. The narrow sticks represent the range that the stock price traded within for the day. What is price support and resistance and how should we use them? Support and resistance lines can be drawn on any stock chart. Technical analysts use support and resistance levels to identify price points on a chart where the probabilities favor a pause or reversal of a prevailing trend. Support occurs where a downtrend is expected to pause due to a concentration of demand. Resistance occurs where an uptrend is expected to pause temporarily due to a concentration of supply. When a stock price moves upward and resistance is broken, the line becomes the new support level. This can be a good time to get long stock or sell put options to get long. At the same time, when a stock price moves down and support is broken, the line becomes the new resistance level. This can be a good time to short a stock. What is a trend line and how do we use it to trade stocks and options? Trend lines are easily recognized lines that traders draw on charts to connect a series of prices together or show some data's best fit. The resulting line is then used to give the trader a good idea of the direction in which an investment's value or stock price might move. A trend line is a line drawn over highs or under lows to show the prevailing price direction. Trend lines are a visual representation of support and resistance in any time frame. They show direction and speed of price and also describe price patterns. Trend lines can be applied to the highs and the lows to create a channel. In this example, you can see that the trend line is moving to the upside. It's common practice among traders to think that the trend is your friend, and until that trend breaks down, you should not trade against it. What are technical analysis formations and how should you use them to trade stocks and options? Stock chart patterns often signal transitions between rising and falling trends. A price pattern is a recognizable configuration of price movement identified using a series of trend lines and/or curves. When a price pattern signals a change in trend direction, it is known as a reversal pattern. A continuation pattern occurs when the trend continues in its existing direction following a pause. Here are some of the common formational patterns. Pennant continuation stock chart pattern. Pennants are continuation patterns drawn with two trend lines that eventually converge. A key characteristic of pennants is that the trend lines move in two directions. One will be a down trend line and the other up. The figure shows an example of a pennant. Often the volume will decrease during the formation of the pennant, followed by an increase when the price eventually breaks out. The flag continuation stock chart pattern. Flags are continuation patterns constructed using two parallel trend lines that can slope up, down, or sideways. Generally, a flag with an upward bullish slope appears as a pause in a downtrending market. Likewise, a flag with a downward bias or bearish shows a break during an uptrending market. Typically, the flag's formation is accompanied by declining volume, which recovers as price breaks out of the flag formation. The wedge stock chart pattern. Wedges are continuation patterns similar to pennants in that they are drawn using two converging trend lines. However, a wedge is characterized by the fact that both trend lines are moving in the same direction, either up or down. A wedge angled down represents a pause during an uptrend. A wedge angled up shows a temporary interruption during a falling market. As with pennants and flags, volume typically tapers off during the pattern formation. Wedges differ from triangles and pennants in that they reflect only upward and downward price movements, so the wedge generally appears angled. The cup and handle stock chart pattern. The cup and handle is a bullish continuation pattern where an upward trend has paused but will continue when the pattern is confirmed. The cup portion of the pattern should be a U shape that resembles the rounding of a bowl rather than a V shape with high sides on both sides of the cup. The handle forms on the right side of the cup in the form of a short pullback and then resembles a flag or pennant chart pattern. Once the handle is complete, the stock may break out to new highs and resume its trend higher. The head and shoulders is a reversal pattern that can appear at market tops or bottoms as a series of three pushes. An initial peak or trough followed by a second and larger one, and then a third push that mimics the first. An uptrend interrupted by a head and shoulders top pattern may experience a trend reversal, resulting in a downtrend. Conversely, a downtrend that results in a head and shoulders bottom will likely experience a trend reversal to the upside. Horizontal or slightly sloped trend lines can be drawn connecting the peaks and troughs between the head and shoulders. The double bottom stock chart pattern. The double bottom, on the other hand, looks like the letter W and occurs when the price tries to push through a support level, is denied, and makes a second unsuccessful attempt to breach the support level. This often results in a trend reversal as shown in the figure. The double top or bottom are reversal patterns signaling areas where the market has made two unsuccessful attempts to break through a support or resistance level. A double top often looks like the letter M and is the initial push up to a resistance level followed by a second failed attempt resulting in the trend reversal. Besides stock chart patterns, there are also technical indicators. Just like chart patterns, there are numerous indicators, so I'm only going to touch on a couple of the more popular ones. RSI is the Relative Strength Index. As a momentum indicator, the Relative Strength Index compares a security's strength on days when prices go up to its strength on days when prices go down. Relating the result of the comparison to price action can give traders an idea of how a security may perform. The RSI, used in conjunction with other technical indicators, can help traders make better informed trading decisions. The RSI indicator can stay in the overbought region for extended periods while the stock is in an uptrend. Likewise, the indicator may also remain in the oversold territory for a long time when the stock is in a downtrend. Many investors create a horizontal trend line between the levels of 30 and 70 when a strong trend is in place to better identify the overall trend and extremes. Moving averages. The simple moving average, SMA, is an arithmetic mean of a given set of values and is plotted on a stock chart. The 20-day, the 50-day, and the 200-day are often used to identify trends. The 200-day SMA is also called the power line, and it is a very strong resistance for a stock. SMAs are lagging indicators since they are derived from past prices. They work best with a stock in the breakout or sell-off stage. When trading laterally, it's not as good of an indicator. The optimal buy signal for a stock price based on SMA is having them all in order from lowest to highest on the chart. The 200-day the lowest, and then the 50-day and the 20-day moving average as the highest. Another popular type of moving average is the exponential moving average, which is called the EMA. The calculation is more complex as it applies more weighting to the most recent pricing. If you plot a 50-day SMA and a 50-day EMA on the same chart, you'll notice that the EMA reacts more quickly to price changes. Neither is better than the other, but either one can be used depending on which one you prefer. A couple of the key takeaways are technical analysis should be used along with fundamental analysis as well as earnings, conference calls, and news. When stock price moves upward and resistance is broken, the line becomes the new support. When stock price moves downward and support is broken, the line becomes the new resistance.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. There's also an automatic options income course as well as link to coaching as well that is very reasonably priced. If you are looking for some help with your trading, I'd love to talk with you. So click the link and sign up. Please share the video with a friend. Remember to hit like and subscribe, and look forward to seeing you in the next one.